Hi friends. Welcome to my channel, InfoCraze. Today we will discuss some important questions that may be asked in a job interview for the position of junior accountants or accounts interns. The interview questions may revolve around assessing your knowledge of basic accounting concepts. This video will be very useful for people in the field of finance and accounts. If you find the content useful, please like the video and subscribe to my channel for having easy access to my future videos in this field. Here are some common questions that may be asked. What are the types of accounting? There are various types of accounting. First is financial accounting, which involves the preparation and reporting of financial statements to external users, such as investors, creditors, regulators, and the general public. The primary financial statements produced under financial accounting include the income statement, balance sheet, cash flow statement, and statement of changes in equity. The purpose of financial accounting is to provide accurate and reliable financial information about a company's financial performance and position. Second is management or the managerial accounting, which focuses on providing financial information and analysis to internal users, primarily management, to support decision-making, planning, and control activities. Reports generated through management accounting may include budgets, cost analysis, variance reports, and performance metrics, tailored to assist managers in operational and strategic decision-making. Third is cost accounting, which involves tracking and analyzing the costs associated with producing goods or services within a company. Its primary objective is to provide management with the information for decision-making, cost control, and performance evaluation. It helps in determining the cost of goods sold, evaluating cost efficiency, setting prices, and making decisions regarding product mix and production processes. Some other types of accounting are tax accounting and forensic accounting. Tax accounting deals with ensuring compliance with tax regulations or laws, calculating tax liabilities, and preparing tax returns for submission to tax authorities. It involves interpreting tax laws, maximizing tax efficiency, and managing tax risks while adhering to legal requirements. Forensic accounting involves investigating financial fraud, embezzlement, or other financial irregularities within a company. Forensic accountants use accounting principles and investigative techniques to uncover evidence, quantify losses, and support legal proceedings. What is the difference between an asset and a liability? An asset is a resource owned by a company that has economic value and can be used to generate future benefits over a period of time. Examples include cash, inventory, equipments, accounts receivable, etc. A liability, on the other hand, is a company's financial obligation or debt that must be settled in the future. Examples include loans, accounts payable, and accrued expenses. How do you calculate the gross profit margin? The gross profit margin is calculated by subtracting the COGS, that is the cost of goods sold, from total revenue and then dividing the result by total revenue. The formula is gross profit margin equals revenue minus COGS divided by revenue. It measures the percentage of revenue that exceeds the cost of producing goods or services and indicates a company's profitability before accounting for other expenses. What is the difference between accrual and cash accounting? Accrual accounting is an accounting method that recognizes revenue and expenses when they are earned or incurred, regardless of when cash is exchanged. This means that transactions are recorded as they occur, rather than when the cash is received or paid out. Accrual accounting provides a more accurate picture of a company's financial position by matching revenues with the expenses incurred to generate them, thus reflecting the true profitability of a business during a specific period. Let's understand this with an example. Say, in January 2024, Company A delivers a service of $1,000 for their client, against which the full collection is received in February 2024. According to the accrual accounting principle, revenue is recognized when it is earned, regardless of when the collection is received. Therefore, Company A records the revenue in January 2024. Since the client didn't pay in January 2024, Company A records an account receivable of $1,000 in January 2024, which represent the amount owed by the client. This reflects the company's expectation to receive payment in future. When Company A collects the full amount from their client in February 2024, they record this receipt as a debit to their bank account and a credit to their accounts receivable account, reducing the accounts receivable balance to zero. Thus, accrual accounting recognizes revenue in January 2024, when the services are provided and the related expenses are matched to that revenue, even if the cash is received or paid out at a later date. This method provides a more accurate depiction of a company's financial performance during a specific period, as it reflects economic activities as in when they occur, rather than when cash transactions take place. Cash accounting is a method of recording income and expenses when they are actually received or paid, rather than when they are incurred or earned. In other words, transactions are recognized only when cash changes hands. In the same example, revenue and expenses will be accounted in February 2024, when the actual cash transactions occur. This is because cash accounting focuses on the actual inflows and outflows of cash rather than the timing of when the revenue is earned or expenses are incurred. What is the difference between accounts payable and receivable? Accounts payable represent the money a company owes to its suppliers or vendors for goods or services received, but not yet paid for. The vendors to whom money is yet to be paid are called creditors. Whereas, accounts receivable represent the money owed to a company by its customers for goods or services provided to them on credit. The customers from whom money is yet to be received are called debtors. What is depreciation? How is it different from amortization? Depreciation is the systematic allocation of the cost of a tangible asset, such as buildings, machinery and vehicles, over its useful life. It represents the decrease in the asset's value due to wear and tear, obsolescence, or usage. Depreciation can be calculated using various methods such as straight-line depreciation, declining balance method, or units of production method. Amortization, on the other hand, is the process of spreading out the cost of intangible assets, such as patents, copyrights, trademarks, goodwill, over their useful lives. It reflects the consumption of the economic benefits of intangible assets over time. Common methods of amortization include straight-line amortization and the effective interest rate method for bonds and loans. In summary, while both depreciation and amortization involve spreading the cost of assets over time, depreciation is used for tangible assets, whereas amortization is used for intangible assets. How is working capital calculated and why is it important for a company? Working capital is calculated by subtracting current liabilities from current assets. It represents the liquidity available to a company to meet its short-term obligations. Working capital is important because it indicates a company's ability to cover its day-to-day operating expenses and invest in growth opportunities without relying on external financing. What is deferred revenue? Deferred revenue, also known as unearned revenue or deferred income, refers to the receipt of payment by a company from its customers for goods or services that have not yet been delivered or earned. In other words, it represents money received in advance for products or services that will be provided to the customer at a later date. When a company receives payment for goods or services upfront, it initially records the payment as a liability on its balance sheet because it owes the customer the goods or services in the future. As the company delivers the goods or services over time or upon completion of the agreed-upon milestones, it recognizes the revenue earned from the deferred revenue and reduces the liability accordingly. What is contingent liability? A contingent liability is a potential liability that may arise in the future, depending on the outcome of uncertain events. Contingent liabilities are typically disclosed in the notes to the financial statements rather than being recorded directly on the main balance sheet. The reason for this is that contingent liabilities are potential obligations that depend on the outcome of future events. They are not certain liabilities that have already been incurred, so they do not meet the criteria for recognition as liabilities on the balance sheet. Disclosing contingent liabilities in the footnotes allows companies to provide transparency to investors and stakeholders about the potential impact of these obligations on the company's financial position and performance without affecting the main balance sheet figures. With this, we come to the end of this video. If you find this useful, request you to like the video and subscribe to my channel for many such interesting topics in finance and accounts. Thanks.